All right, welcome to another episode of Break Away from the Rat Race. And today we have the pleasure of speaking with David Robinson. And David is the CEO and founder of Canovo Capital, which is a boutique real estate investment firm. He's an active investor, broker, and podcast host. And as a broker and investor, David has been directly involved in over $350 million in real estate transactions. That's a massive amount of transaction. And at Canovo Capital, David oversees all due diligence, capital raising, investor relation, and asset management for his firm. David, welcome to the show.
Thanks for having me. Looking forward to our conversation.
Yeah. So tell us about how you got started into and how you ended up going into this being a founder of Cannibal Capital. I'm sure it doesn't happen like, oh yeah, I just got out of college and this is what I do. So what was your journey to get there?
Well, I've got to go back to when I was fired from my first job. My first and only professional job was working for my own father at his mechanical engineering firm. And I was recently graduated from high school. I was in college and working for him part time, and had screwed up a couple things a couple tasks that I was supposed to do. The frustration set in, as I think a father's frustration would set in, and
Yeah.
we mutually agreed that I wasn't a fit to employee, and that sent me on an entrepreneurial path that ultimately led to me getting a real estate license and getting involved early on in just the traditional residential sales business. I got involved in around 2004 and quickly found a niche in the foreclosure prevention and short sale world. And so I
Wow.
built up a large, one of the top producing short sale brokerage businesses here in Utah, where we helped clients through the challenges of the recession.
You
On
started
the
that in
back,
2004, just in time for the 2008.
Yeah, so leading up to 2004, I sort of cut my teeth in the market. This was
Yeah.
before loss mitigation departments were formed, and
Wow.
even banks knew exactly how to work out these type of deals. And so when the recession hit, I was well positioned to really serve a lot of clients in that space, which we did. And then on the back end of the recession, we moved into more traditional brokerage business where I managed sales teams and a national franchise brokerage. Ultimately, after about a decade in the business, I looked back and I realized, my goodness, I hadn't done nearly enough personal investing to
Hmm.
build up any legitimate amount of wealth or cash flow in my life. And that caused me to rethink my whole business structure. And that's when we pivoted and started our own boutique brokerage based out of Salt Lake City, Utah here, where we serve clients who are looking to buy and sell small scale multifamily property for their own portfolios.
Yeah.
So anything under $5 million, all the way down to your typical fourplex, will help private investors buy and sell that for their own personal portfolios. And then about 2 years ago is when we got involved in the syndication side of the business and acquiring large commercial multifamily assets.
Oh, that's very good. And I find that I'm gonna go back to kind of like when your first job and kind of how you got fired. But I think this is kind of interesting because I think a lot of people that I talk to getting fired is kind of or losing their job and stuff like that kind of is a wake up call. It's kind of like it's the catalyst that says, this is BS. I don't want to have that to happen to me again. I'm going to take control of my life and all of that. And if I failed, it's going to be my fault, not some other manager or supervisor that says, oh, or father says, oh, you're no good at this. You missed all these tasks and stuff like that. So that's that.
Yeah,
I found
I
that
would
very
say,
interesting.
an entrepreneurial path isn't easy, right?
Mhm.
So
Yeah.
there's pros and cons to, being an employee. And I have some very, very wealthy friends that, built a career in the corporate world and helped large companies grow and eventually exit. And they had ratable windfalls out of those exits.
Yeah.
And there's not necessarily one path for me personally. I'm just not geared as an employee. I'm geared to, carve my own path and tread my own path. And there's pros and cons to both. And ultimately for me, it was definitely the right path.
Yeah.
But it's not for everybody. That's for sure.
Yeah, I mean, that's true. I mean, you're in control, which means that, you have to be, you're always on, you're always thinking about, okay, well, how, and that's kind of like how I spend my life is how am I going to screw this up? And then kind of
Right.
what's plan B and plan C and plan D, and then kind of like at the same time, how do we grow? Having to look at the economy and making your own decision. Uh, but to me, I find that comforting because at least I'm in control. I can change the direction of how the company is going, and as opposed to if I work for a person, a company, they make the decision, and the decision might be, hey, you know what, we're not going to do your side of the business anymore. We're gonna cut down our staff, and all of a sudden you end up on unemployment line, with a whole bunch of other of your coworkers, and then having to find a job all at the same time. And I'm afraid that we might be, I hope not, but I'm afraid we might be heading in that direction, if we're going to have a recession. So I
Yeah,
would,
I don't disagree with you. I'm the only one in my family that's sort of taken this more of an entrepreneurial path. My other brothers are in the medical fields, and so they're W-2 employees,
yeah,
and there's also some risk in that, right? They've
yeah,
they've felt that themselves as they've had to transition jobs or take pay cuts or whatever it might be, or just corporate challenges that they have to face. But yeah, we could be heading into a time in a place where a lot of those white collar jobs are the ones that actually get trimmed off.
yeah, exactly. So you started working as a broker, real estate broker, and you kind of grew, this franchise. You did very well, and it's kind of interesting to me too that, you worked very well and things were going well, but then you realize that, yeah, the company is going well, but what about me? Like, what am I doing for myself if I want to, do something else, or if I want to retire and all that kind of stuff? And that's when you started, investing, and that's when you started Canovo, Capital. Is that right? Or yeah,
Yeah, that is. It was everything was going well in my business and in my life. You know, Ultimately things were just good.
yeah,
And the challenge with that is that it didn't cause me to really think
yeah,
far enough in advance and to make any significant changes in my world that would potentially lead to more wealth and cash flow, but would make me uncomfortable,
yeah,
right?
yeah,
And there was a moment in time where we had some medical problems in our family. My dad had a heart surgery, and the surgery went well, but after the surgery, he ended up getting an infection and went septic and ultimately died. They revived him, and he's still with us today. But that moment in time really caused me to reflect on where I was and how I was leaving not only a financial security for my family, but also a legacy for my family in the
yeah,
future that they could build on.
yeah,
And that's what caused me to say, you know what, it's time to get out of the comfort zone and move into a space where I'm going to be in closer proximity to investment property and investors that were doing the types of things that I wanted to do. And that's ultimately what caused me to pivot and start our own boutique brokerage here in Utah that was focused on multifamily investment property.
yeah. I mean, people shouldn't wait for a dramatic event in their life to start focusing on their personal life and the legacy for their children. Just take heed from other people's experience. It is important to start thinking about it right now and start preparing for it. It doesn't mean you have to quit your job, doesn't mean anything drastic, but at least start planning about kind of where you want to go, what would happen if you lost your job. Do you have like passive income that's going to help you do that? Do you have the right investment? I have a friend of mine is doing very well in the corporate world, and I had a conversation with him, but he's completely engulfed in the corporate
Mm.
world. He's making a lot of money, but his money, guess where it is? It's in the, it was in
401k.
the stock market. And then, but he didn't manage it even, like somebody else was managing it for him. And because he didn't have time. And I feel like, you want to be able to take a little bit more ownership and of course more responsibility towards your investment, um, because nobody else is going to take care of your money better than you. So I think some, you get some advice obviously and all of that, but you want to be part of the decision. You want to be involved in monitoring and making sure that if you have a significant amount of asset or equity that you're investing, you want to really look at it and be part of that decision-making process for how your money is being invested.
Yeah, I couldn't agree more. I have a lot of both active and passive investors in my network, and the reality is, even the passive investors need to be active. It generally at the beginning of the process, they've got to do their work up front to vet out the deal, vet out if they're investing passively in a syndication deal, they need to vet the sponsor. So even if you are passive, there's still some work to be done for
Yeah,
sure.
exactly. Yes, I mean, I'm all about passive income, but at the same time, you have to, okay, well, this is gonna be passive, but I'm gonna put that money in here, and I vetted that person, and we're gonna talk about kind of like your process for vetting the right syndication. So, Cannibal Capital, you do syndication. How many syndications do you have right now? Is this like a portfolio, or is every deal separate, or how does that work?
Yeah. So syndication was something that was foreign to me until a few years ago. Even being a broker in the space and working with investors, you'd be surprised at how many people just aren't aware that investing in syndication is an option. And so the me getting involved in syndication was really a byproduct of a problem that I was trying to solve for my local investors. I was working with a lot of investors who had bought or wanted to buy multifamily property here in Utah. Well, as I would get into these conversations with them, they it would become clear that they didn't necessarily want to own the real estate.
Mm-hmm. Yeah.
They wanted all the benefits that real estate can provide, the cash flow, the appreciation, the tax benefits, the depreciation. They wanted all that. They thought the only way that they could get it was by buying their own investment property.
Yeah.
But when we really got into it, they just wanted the benefits. They didn't want to own that fourplex, that sixplex, that 12plex, whatever it might be. So I also had the challenge of many of my investors who had bought real estate in Utah wanted to participate in deals that would provide them with more cash flow.
Yeah.
Utah, there's a lot of great reasons to be buying real estate in Utah over the last 5 to 10 years. Cash flow is not necessarily one of those. And so I was challenged to serve my clients that didn't necessarily want to be active investors where they own their own property. B, they wanted to diversify outside of what they had been doing here in Utah.
Yeah.
And C, they wanted to participate in deals that had a better blend of both cash flow and appreciation, which I was struggling to provide them here in our local market because we're in a high growth market, low cash flow market.
That's right.
So all three of those reasons caused me to seek out other options. And I went down a few different paths, ultimately found syndication as a viable model for me to get involved with and help my investors solve those problems.
Mm-hmm.
Help the investors that wanted to be completely passive, help them get involved in deals that had a better blend of both cash flow and appreciation, and C, be highly diversified. Mm-hmm. Instead of buying that fourplex that's going to cost $1 million and is going to require you to put down $300,000 in cash on that fourplex here in Utah on one property with 4 doors in one location, I could potentially help that investor place $50,000 investments across 4 to 6 different institutional quality commercial grade assets in multiple locations throughout the country with multiple business plans and multiple operators.
Yeah.
And so they'd be highly diversified.
Yeah, excellent. Yeah, so basically they're buying when they're buying into your Canovo Capital, they're basically buying into a portfolio of your investment.
Yeah, to answer that question directly, no, we do one-off syndications. So single asset syndications.
Okay, yeah, okay,
So
okay,
my investors, I see my role as going out and finding top tier operating partners
okay.
and vetting the operating partner, vetting the deal, and partnering with those select operators on those select deals, and then
Mhm.
allowing members of my investor network to choose to invest alongside us in those opportunities.
Oh, okay, okay, okay.
And it's a one-off syndication, meaning they're investing in a particular asset with a
Mhm.
particular business plan. They are not investing in a fund at this stage. It may be something that I do in the future, but at this stage, it's one-off syndications.
Oh, okay. So yeah, so the idea in terms of the diversification that they would get would be that instead of putting $500,000 against one asset, they would be able to put $50,000 on this syndication with you, another 50,000 here, 100,000 here, and it would be diversified across multiple assets in multiple
Yeah.
markets and
And
multiple operators.
the majority of my investors have invested in multiple deals with us,
Yeah.
so it gives them an opportunity to invest in different parts of the country with different business plans,
Mhm.
different return profiles, different holding periods, etc.
Okay. So maybe you want to, I know maybe it's a little bit too late to talk about, but maybe some people still don't know what a syndication is. Maybe you want to describe what it is
Yeah.
and kind of give
I,
a little bit of an idea of the breadth of syndications that you have as Carnival Capital.
Yeah, so in the last roughly, so about 2 years ago is when we started exploring syndication. I spent 6 months to a year really vetting sponsors, getting to know sponsors, really learning the syndication model. And in the last roughly 12 months, we've acquired with our operating partners around $175 million of real estate across 5 different assets in 5 different geographic locations. So that's what we've done. And as far as syndication is concerned, at a very high level, a syndication is just a way for investors to pool money and resources to be able to go and buy an asset that they most likely wouldn't be able to buy on their own.
Mhm.
And there's generally two groups of individuals inside of a syndication. You have the general partnership, which consists of the individuals that are sponsoring the deal and are ultimately responsible for the success or failure of the deal. They're responsible for finding the deal. They're responsible for getting it under contract, negotiating the terms. They're responsible for obtaining the debt. They're responsible for attracting the equity and ultimately responsible for executing on the business plan. That's the general partnership. And then you have the limited partners, which are the passive investors, the individuals that are putting their capital into the deal with an expectation of a return. And they are limited in their responsibilities, limited in their liability, and they're, for the most part, completely passive in the investment. And so that's how those syndication deals are structured. There's some restrictions on who can invest in syndications depending upon the SEC regulates these type of deals, and there's some restrictions on who can participate and who can invest and how it should be done. Happy to go into that, but maybe that's a conversation for another
Yeah, I think
time. I don't know.
we should talk a little bit about that. Kind of like what are some of the investors' criteria? Do they need to be accredited investor, or do you
Yeah.
also accept
So
non-accredited investors?
typically in syndications, you're going to find them. So again, the SEC regulates these deals, and there's rules around how because this is a security. Basically, you're investing in a security, even though you get all the tax benefits as ownership of the deal that you're investing in. You are buying units of the company that owns the real estate. So with that being said, the SEC has some rules and some exemptions that allow sponsors to sort of avoid having to register their security with the SEC. And these exemptions are generally known as Rule 506B and Regulation D, Rule 506C. So 506B allows both accredited and non-accredited investors to participate, with the caveat that they need to have a personal relationship with one of the general partners or the sponsors. Okay. And with a 506c, anybody can participate as long as they are accredited. And to be an accredited investor, there's a long list of ways that you can be accredited. But generally speaking, you need to have earned an income of $200,000 with the expectation of earning such over the in the future. So $200,000 over the previous 2 years with an expectation of earning such moving forward. Or you have a net worth of $1 million outside of your primary residence. So they're generally the two qualifiers to become an accredited investor, which I'm sure most of your listeners are aware of. But those are the most common structures, the 506B and the 506C, and some of the differences.
Yeah. And then, so in terms of the investment itself, like what is the minimum capital that's required for your syndication typically?
Yeah, it's going to be deal specific. Generally speaking, though, you're going to see $50,000 minimum investments.
Okay. Okay, sounds good. And the exit period, like how long is the hold period for the investment?
Again, my goal is to provide a variety of investment opportunities to my investors so that they can be diversified, which includes length of the business plan. So we have a couple deals that are 3 and 5 year hold periods, and then we have others that are long-term hold with a refinance planned in year 3 to 4.
Okay.
And they're different strategies. One is more of a long-term hold, higher cash flow deal. The others are shorter term, where we're going in and really increasing the value of the asset with the intent to sell and liquidate.
Oh, yeah, so that's that's good, because there are very few syndications that are actually like long-term play where you're going to get the cash flow. It's focused on cash flow. So I'm very happy to hear that you have a syndication there that's planning on adding value, refi, get some of your capital out, and then having the cash flow following that. So I think that's very good.
Yeah, you're right. The vast majority of sponsors are looking, and that's how these private equity companies grow substantially, is they when they have an exit after they've increased the value of an asset, it's generally, or has been, a pretty big exit, and it allows these companies to be flush with cash to be able to grow at a faster pace. And so you see a lot of the sponsorship groups that will lean into the shorter term because it allows them to really accelerate their growth. But there are some quality sponsors out there who are almost exclusively focused on long-term cash flowing opportunities.
Well, David, that's an excellent segue into my next question about the how do you find the best syndicator to invest with?
Well, I would say, again, going back to this passive investing concept, yes, these type of deals are passive investments, but the reality is there is a tremendous amount of work that goes in up front to identify and vet a quality sponsor. So when I determined that this was an avenue that I wanted to go down, I spent a year getting to know quality sponsors in select markets across the country. I had a unique advantage because I host a podcast that's focused on multifamily investing, commercial multifamily investing. And so it allowed me to network with a lot of these sponsors, bring them on the show, get to know them. But ultimately, when I set out to go and find my very first sponsor that I wanted to partner with and do a deal with, I was looking for a few criteria. Number one, I wanted a sponsor who was local to their geographic investing area. Mm-hmm. Now, there's a lot of investors and sponsors that will invest outside of their local market where they live or where they office. And there's nothing wrong with that. There's many sponsors that are very successful at investing outside of their local market. But for me, with my first deal, I wanted a sponsor who was investing in their backyard, that was entrenched in that local market, that had unique understanding of what was happening in that market, because I felt like it was going to give me a competitive advantage.
Yeah.
So that was number one. I wanted a sponsor who was investing in their local market. Number two, I wanted someone who had a track record of success. And I wanted them to have enough experience that I could feel confident in their ability to perform moving forward. And so for me, that meant I was seeking out a sponsor who had at least 1,000 units under their belt, meaning they had acquired at least 1,000 units across 5 different assets. I also wanted, for my third criteria, was I wanted someone that was on a growth trajectory. I didn't necessarily want to be working with a sponsor who had been in the business for 20 years, built up a $1 billion portfolio, and was sitting back on their haunches enjoying what they've built. Yeah. I wanted a sponsor. My investors want to place their capital in deals, active deals that can provide a good return, which meant I needed to be working with sponsors that were active in the market and were out hungry, hunting for new opportunities. And then lastly, it was values aligned, which is the hardest of them all, because it takes a tremendous amount of time to get to know people. Okay. And so when I say values aligned, I wanted to be working with someone who was going to treat my investors the same way I would want them to be treated, who I knew would do the right thing regardless of the circumstance and how difficult things got, and who had excellent communication, meaning regardless of good or bad, they're communicating effectively and timely. And lastly, it had to be someone that I liked. Yeah. Because I was going to be a partner with this person for the next 3 to potentially 10 years. And so it needed to be someone that I actually got along with, that I enjoyed working with and alongside with, and I had confidence and trust in them. And unfortunately, that's the piece of it that takes the longest time frame, is getting to know these people, how they function, who they are as a human being, and how they're going to react in difficult times.
So which one came first? Like, did you choose the market first, or did you find sponsors and say, oh, this sponsor is great, it doesn't matter where the market is, if you find a great sponsor, it's going to work out? Yeah,
that's a great question. Today, it's less about the market and more about the sponsor. But I will say on that very first deal, I had identified a few select markets because of what my investors were looking for. Mm-hmm. That I wanted to focus on, and then I sought out sponsors that were in those markets. Okay. Today, as my sponsor relationships have grown, it's more about doing. I believe that a good deal can be done in almost any market. That being said, we gravitate
except your own local market.
Well, good deals are being done in my local market all day long.
Yeah.
But there's also something to be said about diversifying across multiple markets,
and also about your goal, right? It's a good market for certain types of investment, but if you're looking for more passive income and cash flow, then maybe your market. The same thing for me. Like, I was in California, it didn't make sense to invest for cash flow in California, so I had to go outside. So it's the same thing. I was a little bit.
Yeah, it just depends on the strategy and the goal. Depends on the strategy and the goal of the investor, for sure.
Okay. So what are some of the criteria that you had for the market selection?
It was pretty simple initially. I was looking for markets that would provide, and keep in mind, one of my early goals was to investors with a better blend of both cash flow and appreciation. So I was looking at markets that had had a good price to rent ratio, and would provide a better cash flow and appreciation. Mm-hmm. In addition, I wanted a market that wasn't boom or bust. And so I was seeking out the Midwest markets. And there's a few select markets that that were very stable. They weren't boom and bust. You didn't see big spikes. You didn't see big drops. There wasn't a massive influx of population, but there also wasn't a drop or decline. Yeah. And so they were just very stable, secure, safe markets to be involved in. And that's what I set out to find initially. We ended up investing in Kansas City, which has been more of a growth market than initially anticipated. But it mainly became because of the sponsor that I had built a relationship with.
Hmm. Yeah, I mean, I invested in, I still invest in Cleveland, and it's very similar criteria. I mean, we put like landlord friendly in there, would add that, but good price to rent ratio, also what I call sustainable growth. Just nothing to write home about, like nothing to be excited. If except if you're from Cleveland, then yeah, definitely lots of things to be excited about. But in terms of the economy and stuff like that, yeah, it's just solid, no boom and bust.
In fact, you mentioned Cleveland. We've done a deal in Northeast Cleveland an affluent suburb,
Yeah,
Mentor, northeast suburb of Cleveland, Mentor, Ohio. And Mentor, I believe, if I got the statistics right, over the last 20 years has only seen a population growth or decline of less than 1%.
yeah, that's right. Yeah,
So
so
not
yeah,
super sexy,
yeah,
not super sexy, but a very stable market.
yeah. And what's the population in Mentor?
I can't remember off the top of my head. I'd have to go
Uh,
back and look, but
100,000, 200,000 maybe. I don't know.
yeah, I believe it was like 175,000 or something like that, you know.
So 1% of that up and down every year, like 1,000 people in
It's
and
pretty
out.
minimal.
Yeah, so it's not many
Yeah.
people. But
And the median household income was really high, like $72,000. So
okay,
pretty strong median
yeah,
household income.
yeah. So yeah, that's good. So yeah, so it sounds very interesting because I that's same for me too. Like we found that the Midwest, the Rust Belt, was kind of like the area where you can really have like people that have good jobs. They have the price to rent ratio is good. Everything is good. It's just not exuberant like you see on the West Coast. Like you have these exuberant growth
Yeah.
pattern and all of that, and it's just like nobody can afford that, then you have to move like 2 hours away and blah blah blah. So,
And I would say that's another reason why we've also invested in Texas
mhm.
and in Georgia, as well as in Utah, because those markets also are higher growth markets. I
Yeah.
don't only want to be investing in deals that provide cash flow. The
Mhm.
reality is no one gets rich off of cash flow.
Mhm.
Cash flow, the way I look at it is I want to be placing bets in a few different markets. But where I'm at in my investing cycle personally is that I want to be investing in markets where there is a quicker turn, where there's higher growth potential, where we can liquidate, and then I can take that equity and then go and place that in cash flowing deals.
Mhm.
And so it really depends on where investors are in their life cycle.
Yeah.
That being said, again, my goal is to provide a blend of opportunities for my investor network.
Yeah, and I think that to me, like the difference when you're doing these value add deals and these appreciation deal, you need more time to do that, or you need to have a sponsor is gonna do all the work for you. I think if you're an investor, you're going to invest passively with a sponsor that's going to work on the appreciation side of it and the value add, and then the rest your money, when you get your money out of that, then yeah, you should invest in passive income deals yourself. So I think that would be, so that way you can have like a diversified portfolio. But I think to me
Yeah.
the important criteria, I think as an individual, you and I are lucky because we can spend all day investing, but a lot of people are working, and they don't have the opportunity to spend like 2 days with a contractor walking through a property and all that kind of stuff. So
That's right.
yeah. So then you found the market, and then on your show, then you talk to a lot of sponsors, and then kind of like decide what. And the sponsor would find the deals, or how would you find the opportunity? Like,
Yeah. I actually don't spend any time sourcing commercial syndication deals.
oh, really?
Um, we partner with sponsors who generally are the ones with the relationships with brokers in their local market. Once they have a deal under LOI or pre-LOI, they'll bring it to us. We'll do our own due diligence on it. We'll vet the deal. We'll underwrite the deal. If we as a team and a partnership feel like it's a good opportunity, then we'll move forward from there. But
I see.
generally, my partners are the ones sourcing the deals in their local markets.
Oh, so that's great. So you have a network of sponsors that I say, and then they come to you for the capital raise, and then the investor relation, the asset management piece of it. but then they find the deal. They manage everything on the ground because they're strong on the local market. So
Yeah.
okay, I see. So it is similar for me. Like I'm a lot on the single family rental side of things, and it's kind of the same thing for us too. Like we have, a team on the ground. They're local. They're completely invested in their market, and then we source some of our deals, but they also send us their deals also.
Hmm.
And then that kind of they know where to go, they know all of that, and then they manage the properties for us. So that makes it super easy. But
Yeah.
yeah. So we found the market first. Then from the market, then we found the sponsor or the property management company that was solid, and then after that, then we found the deals and we managed the deal that way.
Yeah, and I'll say some of my operating partners actually have integrated property management into their business.
Yeah.
So others will use third party property management, and I think there's pros and cons to the both.
Mhm.
But ultimately, it's critical to have a great property management relationship.
Yeah. No, absolutely. Yeah. I think also depending on the size, right? I think some of the investments that you're making are actually in a smaller size. So, and by smaller, I don't mean like, uh, yeah, I mean like still a significant size, but not 100 doors and 200 doors. So for these markets, I think you may not have like in-house property management that's going to be in there. Uh,
For ours, we're generally only targeting deals that have 100 units or more.
oh, you are?
Mentor,
Okay, okay, okay.
yeah,
Oh.
Mentor is our smallest asset, and that's 72 units. But
Oh, okay.
like 164 units in Kansas City, 345 in Houston, another 300 in Georgia. So
Oh,
yeah,
okay.
these are bigger assets.
Oh, I see. I was under the impression that you actually went for even the smaller assets than that, like
No, now from
140.
a let me clarify. I have two parts to my business. My brokerage business here locally in Utah
Yeah.
is serving private investors who are buying small scale multifamily for their own personal
Oh,
portfolios.
okay, okay, okay.
So anything under $5 million, but they're buying that as a sole investor.
That's right. Not a
These are
syndication.
business owners, high net worth individuals, doctors, lawyers that are buying a 12-plex, a 24-plex, a 6-plex for their own
Yeah,
portfolio.
yeah, yeah. Okay.
These deals, the syndication deals, are usually, at a minimum $10 million up to the Georgia deal was a $100 million project.
Yeah. Okay. Okay. Very good. So, what about the any particular? Not actually. When you started Cannibal Capital, your goal was to actually build your own personal portfolio and stuff like that. So, did you end up? I think did you end up buying any of these investments, or are you invested basically
Oh
in
yeah.
the
Yeah,
syndication?
I invest in every one of the deals that we're involved in.
Mhm.
I actually avoid buying small scale multifamily property here in Utah because I want to focus on my investors who are buying here locally. And I
Mhm.
don't necessarily want to compete with them.
Yeah. Yeah.
And so we only provide brokerage services in that regard
Hmm.
for clients that want to buy that product type. But yeah, absolutely. Through the syndication model, I invest not only as a limited partner, but also have equity interest as a general
Okay.
partner in every one
General
of
fund.
those deals.
Okay. So you're obvious. So in terms of the capital raise, I mean, this is all. And whenever you're an investor, even if you're an active investor, you're always looking for money. My saying is always like, it doesn't matter how much money you have, you're always short a couple of millions, and it's so true. And but it's important to know how to raise money, and I think that for you, I mean, you're doing that basically all day, raising money for all your projects. So any kind of like tricks or kind of like things that can help other people that are raising money for their own deals that you can share with us.
Yeah, I've often talked about my first raise where we raised $1.4 million in 48 hours without any prior capital raising experience. Now, the reality is that yes, it was 48 hours from the time we released the deal to when it was oversubscribed. But the reality is I spent literally 12 months preparing for that first deal to go out, right?
Mhm.
I
Yeah.
talked about how I went through a process of vetting all these sponsors. and vetting deals. Also, meanwhile, I'm communicating with my investor database.
Yeah.
I'm telling them, I'm having conversations with my investors on a daily basis about what they're looking to do. And so when I started to formulate this business strategy, I sent out an email to my database and I said, hey, this is what I'm looking to do. Would you be interested in participating in a deal in the Midwest that provided a better blend of both cash flow and appreciation than we could see here in Utah? Mm-hmm. And I had a very, very strong positive response to that email. And so then I started to communicate what the strategy was, the type of deals I was looking at, the type of sponsors I wanted to be doing business with, and spent, a significant amount of time preparing for that. Once I had the deal under contract, I flew out, I met with the team, I vetted the deal, I toured the asset, I toured comps, I toured the market. We recorded video. We did an introduction webinar to the sponsorship team. And all this time, I'm communicating this to my investor network so that when we were ready to release the deal, all my investors were teed up and excited about the opportunity. And so we oversubscribed it. We couldn't, allow everybody who wanted to participate. And that's a wonderful place to be as a capital raiser.
Mm-hmm. Yeah, because there's also even if a lot of people that have big wallets and they have assets, significant amount of cash to invest, there's also a question of timing. None of these investors are sitting on cash forever. I mean, they want that cash, and same for you and I. I mean, we want that cash to work for us. It's not sitting in the bank. That's the last place I want my money to be. So you invest it in assets. So there's a question of timing also. And I think this is potentially one of the many reasons why you were successful in raising it so quickly, is that people can then just adjust their timing also for when that money is going to become available for your investment.
Yeah, I think there were plenty of our investors who held off on other opportunities because they knew something was coming through the pipeline. Yeah. And so that's important to keep communicating with them. And what I've experienced is that about 10 to 15% of our investor network have invested in each one of our deals. So when you think about that, if you need, let's just call it $1 million to make the numbers easy, and you have a $100,000 investment, well, you need 10 investors, right? Yeah. Well, you need to have a database of at least 100 quality investors who have the capacity to invest to be able to get 10 investors to invest that 100. So it really, you have to have a lot more of a robust network than you think for the amount of equity that you want to raise.
Yeah, that's right. Yeah. And for us, I think, we have a lot of the investors that we have, they're not even accredited investors. So most of them are non-accredited that we have a long-term relationship with. So, so for us, it's even like the response is, we have a lot of investors, but for us, like maybe it's like,
they might go a whole year with being able to place an investment until the next time they can make an investment.
Right. Exactly. Well, David, it was great talking to you. If people want to reach out to you, they want to know more about Cannavo Capital, also your podcast. So where can they reach out to you?
Thanks for that, Eric. I like to give out a free resource, something completely free of value. One of the many conversations I have with my investors is all about how their property is currently performing. And one thing that my investors often overlook with their own personal portfolio is they're always looking at their cash on cash return, and it's solid and they feel like the performance is good, but they neglect to look at their return on equity.
Oh,
anybody who's bought
I can't believe it.
Anybody who's
bought, the only one. You and I are the only one talking about this.
Well, I think others are, but it's often overlooked. The reality is anybody who's bought real estate in the last 10 years has a tremendous amount of equity built up in that property. And as that equity builds up, your return on that trapped equity goes down. Yeah. So many investors who think their investment property is performing well, when we help them run a return on equity analysis, They realize it is underperforming substantially, and it's time for them to reposition the equity that they have built up in their portfolio.
Yep.
And so I've got a free resource for anybody that wants to use it. It's just returnonequityreport.com. If they go to returnonequityreport.com, we have a free calculator that they can use to run their own return on equity report quickly within like 5 minutes.
Oh yeah, that's fantastic.
Outside of that, they're welcome to reach out to me at canovocapital.com. That's CANOVO capital.com, canovocapital.com.
Yep.
And then our podcast is the lead sponsor podcast. We interview apartment syndicators and investment fund managers who have acquired at least $100 million of real estate.
Excellent. Are you on social media at all, like IG, Instagram, or anything like that?
Yeah, you can search me up. I'll send you a link, Eric. You can include it in the show notes. But Instagram, david.theon.robinson. That's a long one. Or just search me up, David T. Robinson on LinkedIn.
Okay.
David T. Robinson on LinkedIn.
Okay, very good. Well, David, it was a pleasure speaking with you, and talk to you later.
My pleasure. Thank you.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.